So here is a charitable person, and he's been watching a webinar for 22 minutes and hasn't gotten anything out of it yet. He's got $11,700,000 in assets, plus a $20 million S Corp. Actually, he's got $10 million in stocks and bonds and a $21,700,000 S Corp. You should read the instructions. On his death, he's happy leaving $11.7 million, which is what's left of his estate and gift tax exemption, to a trust for his children, grandchildren, and great-grandchildren. He feels that's enough because of what they already have and what he feels like they need. And the rest, if it wasn't an S corporation, could pass to a charitable lead annuity trust, which could benefit his descendants for their lifetime. Oh, by the way, everybody on this webinar gets a free book. Just go to my Amazon website, find the book that you want the most, and just let me know which one it is, and we'll get you the PDF of that book at no charge whatsoever. I hope it has words in it. Okay. So anyway, he dies. Everybody's sad, except the grandchildren and the charities. And the S corporation goes into the charitable lead annuity trust and loses its S election, so it has to be a C corporation. And then the charitable lead annuity trust makes payments to charity over a period of years, typically 20 years. And then what's left at the end can be used for his descendants. But he's going to lose his S election. Now, one thing I want to mention is that in the old days, back before we had Revenue Procedure 2021-40, at least while he was alive, he could owe a $20 million note to a limited liability company and then transfer a 99% ownership interest in that limited liability company to a charitable lead annuity trust. He would make the payments on the note. The limited liability company would pay dividends to the CLAT. The CLAT would make payments to charity. And at the end of the CLAT term, there would still be money owed on the note that would go to his descendants tax-free. And if he died owing a $20 million note, he would have no estate tax because his net worth would be about $11.7 million. Then Revenue Procedure 2021-40 came out, and the IRS said they won't rule on that anymore. So what is it that he can do? What he could do is, instead of using the CLAT, he could set up a foundation run by his children that would not pay anything to his children after 20 years. And then on his death, you could use the administrative note exception. So on his will would basically say, on my death, leave the S Corp to the charity, but I've given the GST trust the right to buy the S Corp stock from the charity during the administration of my estate for what they call an administrative note. And then that note owed back would enable the GST trust to own all the assets, including the S Corp stock. The GST trust would owe a $20 million note to the charity, but it would only be at the applicable federal rate. And if and when and it would be interest only for like 20 or 30 years. So the S Corp dividends come in, you use that money to pay the note, and hopefully there's a lot left in the GST trust if that's his intent. Then the charity can become a public charity by becoming an educational institution, a house of worship, a medical research organization, or a clinic that qualifies as what they call a hospital in the code. And then they could buy that note from the charitable organization for a large discount, maybe a 35 or 40% discount. So then they pay the charity for $12 to $14 million. The charity has 12 to 14 million. They have the $20 million S corp, and there's been no estate tax paid. So that is called the administrative note exception to the self-dealing rules. Now, thinking about this, we don't really know whether a wrapped note works it or not. The IRS thought it worked because they issued revenue rulings they issued a string of revenue rulings, like 6 or 7 of them, right up to revenue ruling 2021-01002. They thought, Chief Counsel's office in Washington, D.C., where they issued these rulings, thought that wrapping the note was fine. Now they say, wait a minute, because you can't owe a note from a related party to a private foundation, you can't wrap a note in an LLC and give the LLC to a private foundation. Well, there's a solution for that. You give the note, or you wrap the note, and you give it to a public charity. That is one solution. The other solution is the administrative note exception. So what you could do is, if your client has a large note owed to them, and so many clients do, they, from a trust, they might wrap that note in an LLC, and then on death leave the 99% ownership interest in the LLC to a CLAT or a private foundation, but give the dynasty trust for the children the option to buy it for a note, and then give the CLAT the ability to disclaim it. So the client dies, the family hires a tax advisor. The tax advisor says, well, it's a little bit risky to let this LLC that owns a note goes into the CLAT. You want to take the chance? The family says, yes. Okay, then you do what these private letter rulings allowed and hope that the IRS doesn't shoot you. Or alternatively, the family says, we don't want to take the risk. So the CLAT trustee disclaims to the family foundation, which becomes a public charity by becoming an educational institution, or the family and the family buys it for the administrative note from the private foundation or the public charity. I just did a terrible job explaining that, but I think it shows you that there are some things you can do with these administrative notes. Now, another thing you can do in planning for a liquidity event is you can go ahead and do an installment sale of what's going to be sold into a dynasty trust or a SLAT in exchange for a note. And then the dynasty trust can put that into a charitable remainder trust, and the charitable remainder trust can sell the asset. And if this occurs, you've got estate tax plan savings, and you've also got income tax savings. There's 2 orders of this that you could follow. The first thing you could do is you could first put the asset from the client into the charitable remainder unit trust. The client may take back a unit trust interest that's loaded to be worth 90% of the value of the underlying assets donated to the CRUT. But what is that really worth? If I put $10 million worth of assets into a CRUT, and I have the right to receive 11% of the value of the the CRUT assets each year for 20 years, and let's say it's a flip NIM CRUT where you can't really be sure when you're going to get paid, would you value that at 18 million, or would you value that at 15 million, maybe 14 million? So then that unit trust interest, you have it held under an LLC. You keep the 1% LLC interest, you sell the 99% LLC interest to the Dynasty Trust. Maybe you could get a very large discount and save a lot more estate tax than you would have saved if you had not done the charitable remainder unit trust. The other alternative is that first you do the sale to the Dynasty Trust. It's completely out of your estate. And then the Dynasty Trust makes the donation to the Charitable Remainder Trust and elects, basically structures it not to get an income tax deduction. You do that by making the remainder beneficiary of the Charitable Remainder Unit Trust changeable by the grantor, and the grantor could change it to a police or fireman benevolent association or a cemetery association. So then there's no income tax deduction. There's no gift tax deduction because it wasn't a gift by anybody. A transfer by a Dynasty Trust is not a gift. And if there's no income tax deduction and there's no gift tax deduction on the funding of a Charitable Remainder Trust, then the self-dealing rules don't apply. The Charitable Remainder Trust could sell the asset and loan the money to the family. The family could use the money to invest in a business or investment and pay back tax-deductible interest at fair market interest rates, which the Charitable Remainder Unit Trust would not have to pay tax on, and no tax would have to be paid on that until the Charitable Remainder Unit Trust empties out many years later. So that's another strategy that I think is worth thinking about. Another strategy for charitable remainder trusts, when you get a client who says, wait a minute, when I set up this charitable remainder trust, I see that 10% has to be for charity. Well, it's not truly 10% that goes to charity. It's that at the time you set the trust up, if you wanted to qualify for the tax deduction and or the tax deferral, under the actuarial tables, the remainder interest to charity has to be expected to be 10%. But those actuarial tables are based upon based upon a rate of return assumed to be 120% of a 6-year T-bill rate, right now 5.2%. So in reality, that charitable remainder unit trust, if it's invested properly, may earn a much higher rate of return, in which event the remainder interest will be higher. And the client may be primarily looking for tax deduction and tax deferral and not really to help charity. So to bolster the economics of this, you can remind the client and show the client that they could charge a trustee fee. In fact, maybe children and grandchildren who are in lower tax brackets, or maybe your nephew, the tax lawyer, who doesn't earn much money and is in a low tax bracket, could charge a trustee fee, maybe 0.9 or 1% of the value of the trust assets, providing more for the family and less for charity, if that's what people want to do. So you look here with a 1% trustee fee on a net income makeup charitable remainder unit trust, $10.5 million going to charity in this illustration that Brandon ran, which started with a $15 million charitable contribution, versus now in scenario 2, you take the 1% fee and you end up with less to charity, more to the family. Another thing we do is we have a conversation with the client, which is, what is it worth to you to know that in 20 years, your children will have $10 million in a charitable foundation? What would you pay today to have control of a $10 million charitable foundation? Well, you would pay maybe $1 million for the the feeling that you got that somebody matched you 14-1? I mean, would you pay $1 million? And then what would you pay someone if they told you that they would have a company that would always employ your descendants and friends and employees, whoever, at fair market value, white collar compensation rates? Well, that would be worth something. I mean, if you came to me and said, Alan, in 20 years, your children will have a $15 million company. They can only take reasonable compensation out of it, and they can only use it for charity. What would you pay for that to happen? Well, I mean, if you wouldn't pay $1 or $2 million for that to happen, I think you probably would need to have your financial head examined. So when you take the tax deferral, the charitable deduction, the creditor protection advantage, the good for society, and the real value here, then the client may be happier to do this, even if they're not all that charitable. Another thing I wanted to make mention that I'll be talking about for the UJA discussion is a lot of people think that you can't remain in control of a company and give the rest of it away. They think that if you have to stay in control of a company, you have to give up. I mean, if you want to give a company away, you have to give up control. And in fact, Paul Newman's salad dressing company apparently thought that, because they went to Congress and got special legislation which allowed them to do a complicated thing that's not nearly as good as what I'm about to show you. So I just don't think they knew about this. And that is, you can put the voting stock of a for-profit entity, whether that's a C corporation or a S corporation or a LLC taxed as a partnership, have it go 1% voting, 99% non-voting, and then place the voting rights into a special section 4946A1G trust. Now, I know most of you are saying, oh yeah, I know the 4946A1G trust. I didn't know about it until a client asked me, how do you do this? And it took me a long time to figure it out. I had to ask a lot of people. But this trust can benefit it can be used 35% for your family and friends and 65% for charity. And if you set it up, you can be in charge of it, and it can hold the voting stock, and it is not considered to be a disqualified person. So while I would be a disqualified person, and I would not be able to own 1% of my company and give 99% non-voting to a charity, I could control it as the trustee of a 4946A1G trust. I could also set up a 501c4 social welfare organization, which a lot of people use to make tax-advantaged political contributions, and that could be the owner of the 1% voting stock trust. And now I can put whatever portion of this entity I want into a private operating foundation and get the same tax deduction I would get if it was going to a public charity. You know, we did this for one client who had a lot of capital gain assets. I mean, a lot of capital gain assets, and he wanted to sell them and do other things with the money. He didn't want to pay tax, and he wanted to eventually leave it to charity. So we had him transfer the 99% non-voting member interest in an LLC full of these capital gain assets to a family foundation. He got a tax deduction at full value, and then the LLC sold the capital gain assets, and guess what? There was no tax because it was owned by the charity. And then the LLC put those assets into an S corp owned mainly by the into a C corp owned mainly by the charity, and it operates a business and is owned by the charity. the same way that Harvard University owns a number of businesses. So these possibilities are out there, they exist, and let's not forget about them. So I have slides here that you can look at on this administrative note planning. I have slides that you can look at on the zeroed out plat planning, and just lots of nice things you can do, little bit of text about them. So now I want to talk about zeroing out the estate tax when you have a large IRA, because this may be of interest to you. So let me find the slides for this. All right. So this person has a $15 million exemption. And the reason is she has a $13,610,000 exemption, and her spouse died and left her about $1.4 million of DSUA. So she's got a home worth $3 million and an IRA worth $20 million. That's $23 million. If she leaves that to her children, as you know, they're going to pay a lot of income tax when they pull the IRA out, and they're going to pay a lot of estate tax. But she's charitable, and the children are charitable. So she's going to leave the children the house, and she's going to leave the children a $12 million IRA, 60% of the IRA. She's going to leave 40% of the IRA to charity, and there's no estate tax. And that's not a bad thing. I mean, if you can zero out the estate tax with an IRA, that's pretty good. And it doesn't work to give an IRA to a charitable lead annuity trust. But what about a charitable remainder trust? Could I have the IRA payable to a charitable remainder trust on her death that would result in an $8 million charitable deduction? And the answer is yes, I could. In fact, you know, I wouldn't have asked the question if I wasn't able to say yes, I could. So I ran the numbers this morning, and I had to assume a 75-20 rate of 5.4%, which is a little bit higher than the present 75-20 rate, in order to do a 20-year charitable remainder annuity trust. So at a 5.2% 75-20 rate, which is what it is right now, it would have had to be about a 17-year charitable remainder unit trust, because the payment has to be at least 5% of the initial value. So assuming a 6% rate of return of investments, the IRA goes into the charitable remainder unit trust, and the charitable remainder unit trust pays 5% of the day one value of the IRA to descendants for 20 consecutive years. That's $1 million a year. Sounds pretty good for 20 years. And what's left goes to charity, which is $13,382,766. Now you say, you know, what's good about that? Why is that better than leaving $12 million directly to the children? And the answer is, the big answer is, if the investments go poorly, the charity takes it on the chin. The first dollars out of the CRAT go to the children. So they get two benefits here. One benefit is they get paid over 20 years instead of 10 years because of the minimum distribution rule. The second benefit is they can't blow it over 10 years. They can blow it over 20 years. And the third benefit is if the investments have a 0% rate of return, the children are still going to get all their money. If the investments Here, on the 12 million have a 0% rate of return, they're not going to get $20 million. They're going to run out in year 12. And a charitable remainder annuity trust is creditor proof under the law of Florida and other states because it is an annuity contract. So that's a really good way to handle an IRA when you have more IRA than you need. In other words, there's part of the IRA is going to go to the descendants, part of the IRA is going to go to charity. It's better to use a CRAT in some cases. Now, I also ran the numbers on having the IRA, $20 million paid to a flip NIMCRUT, or a charitable remainder unit trust, that would then pay a unit trust payment for a number of years, with the remainder going to charity. And if the values go up by 6% a year or more, the family's probably better off with the unit trust, but with a flip NIMCRUT, they wouldn't have to get exactly paid every year. They could delay the payment. So I ran the numbers this morning. It took about an hour. I used the software. If anyone wants to know how I did it, I'll be glad to show it to you sometime. But if for this CRUT, which got an $8 million charitable deduction and paid 5% of the value of the CRUT assets each year, I had to go with an 18-year CRUT to make the numbers work. If the assets grow at 6% a year, the average payment is about $1.1 million a year for 18 years. The charity gets $23 million at the end. But the present value of that charitable remainder interest would be about $8 million. So that's a better deal if the assets will go up by 6% a year. It's better for the descendants. If the assets will go up by 7.5% a year, then the descendants average $1,230,000 a year, and the charity has a present value of about $10.5 million. On the other hand, if the rate of return is 0%, because the investments don't do well, then the payment is about $700,000 a year, and the charity ends up with $7.6 million. So they would have been much better with the CRAT instead of the CRUT, and that's pretty instructive. Now, if you did a flip NIMCRUT, no payments at all for the first 11 years, then the family would have received $12.3 million at the end of the 11th year. They would have had all that deferral working for them, and then they would get $1,185,000 a year for the remaining 7 years. Charity ends up with $11.5. And a flip NIMCRUT with a 7.5% rate of return, the numbers are even better. So I'm not sure, this client may want to have half of her IRA go to a 40% CRAT and half of her IRA go to a 40% NIMCRUT in order to defer income tax for the children, avoid federal estate tax, have creditor planning, and keep her tax lawyer and CPA out of the poorhouse, as they call it. I don't know if the poorhouse is a cliche now or not. Let me also mention your S Corp can make contributions of assets to a charitable remainder trust, and that can work very well. But let's go to Grantor Trust now. So let me look for questions, and I hope no one says I can't hear you, because then I'll cry. Okay, you can hear me. One person says, I can hear you, but I don't want to. And that person is my wife. Okay, Alan, are you able to have a 2-generation CRUT? Well, yes, as long as the numbers work, and I won't go into detail. For the life of all beneficiaries rather than term. Yes, you could do a lifetime CRUT for this. I didn't, but that's something that the numbers would be worth running, Alan. So thanks for asking that. Okay, Judy, I've been asking about using a state view with an IRA for a while. I purchased a state view. Would love to understand how you ran those numbers. We've been slowly converting to Roth for a client. Okay, maybe at the end here I'll show you some of the numbers because I left them on the computer. All right, so now I'm going to steal the materials that Jerry and Brandon and a very, very bright financial advisor from New York who's also a tax lawyer and can bend over backwards and touch his toes, Brad Dillon. They came up with this spreadsheet that Jerry just presented at the University of South Carolina, October 17, which was just a few days before I did a 22-minute webinar with no sound. So, by the way, the attentiveness was the same with all of you asleep. So, as Jerry always says, when you go to move assets out of a person's estate for estate tax purposes, we like to use the installment sale to the Grantor Trust for 4 reasons. The first reason, and I'll tell you what the installment sale is. I don't have a good picture of it at the moment, but here's the person. The person owns an LLC. She puts $30 million worth of investments in the LLC, and then she forms an irrevocable trust for her descendants. And she makes a $2 million gift to the trust. So she's got $30 million in an LLC, and she's made a $2 million gift to the trust. Now, the trustee of the trust comes up to her and says, I've got an idea. She says, what's the idea? The trustee says, I would like to buy 99% ownership in your LLC in non-voting shares, and I will give you a note for $20 million. I went to a valuation firm and they told me that because of what's in that LLC, 99% non-voting is only worth $20 million. And I talked to a tax advisor who saw some weirdo on a webinar, and the tax advisor said that the interest rate on the note only has to be 3.96% because of the month that this is occurring in. So you give me $2 million as a gift. Thank you very much. Give me 99% of this LLC worth $20 million that's really worth $30 million when you liquidate it. And I will give you a $20 million note that will pay you interest of $800,000 a year. And if you'd like to make distributions every once in a while from the LLC, I can use those to make the interest payment. So now you have the client who has reduced her net worth by $12 million. She started off with $32 million, 30 in an LLC and $2 million in her hand. She gave $2 million to the trust. She sold 99% of the LLC for a $20 million note. She went from a net worth of $32 million to a net worth of $20 million. She's only used $2 million of her exemption. And now her estate, instead of growing by the growth rate of a $32 million investment portfolio, it's growing by a $20 million note, and the note is growing at the applicable federal rate, which is the long-term average rate of return on T-bills for the year of the transaction, which is about 3.96%. So the growth of her estate is reduced significantly. And then the next thing is if that wasn't good enough, she pays the income tax on the trust income because the trust is disregarded for federal income tax purposes. By the way, I'm going to go till about 12:25 if the sound holds out. So in 10 years, if you use the rule of 72, which is when you're 72 years old, you can't do much math, but you can understand that things double on average at a rate of 7.2%. That 30 million have been used some to make payments, but mostly to grow, and maybe it's worth 55 million. The note is still 20 million. She liquidates the LLC. The trust gets a check for just about 50 million, repays her the 20 million, and has about $30 million left over that's out of her estate that was all based on a $2 million gift. So what Jerry and Brad and Brandon say is, you've got the valuation discount going from 30 million to 20 million. You've got the assets growing, but the note not growing. You've got the grantor trust status, and you have a tremendous amount of federal estate tax planning. And over time, what do you think saves the most tax money? Is it the discount? Is it the difference between the rate of growth and the interest on the promissory note? Or is it the fact that the grantor pays the income tax on the trust income? And Jerry points out that over time, that payment of the income tax on the trust income, which is called the burn, is going to cause that trust to get big, 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 and the client's assets to get small, small, small. So they ran the numbers here on a $32 million sale, basically, and the burn and the payments of the interest, the burn, taking that client's net worth down to zero by 2057. And then they show here another one. So these years, as the client gets older and the income tax on the trust takes the assets out, that's really good for the kids because it reduces estate tax. But the client may not feel that comfortable with it. And I've got Brandon's slides here, which, show the impact of the burn. So one thing we want to do, obviously, is figure out how we're going to mitigate the impact of the burn. And one thing you can do is you can what we call toggle off grantor trust status. So at a certain year, you can cause the trust to start paying its own taxes. Or you could divide the trust into two separate trusts and have the trust pay its own taxes. Now, are we sure that in the future the Internal Revenue Code will let us toggle off grantor trust status? You can't be sure of what the tax law is going to do. I would think that it would be highly unlikely that might happen, but there is a little bit of question as to if you do a spousal limited access trust and your spouse is a beneficiary of this irrevocable trust, because of the tax law change that was made as part of the 2017 Act, which deleted Internal Revenue Code Section 682 from the Internal Revenue Code, it's not absolutely clear that you can toggle off grantor trust status for a spousal limited access trust. So Jerry and I went through this because we spoke at a New York University tax event a few months ago. And one of the things you could do is when you set this up, start with a promissory note that's higher than the applicable federal rate, because you could start at 3.96%, and then when you run the numbers, the client may run out of assets, but or maybe you do just instead of a 20-year note for the client's life expectancy, if they're in their early 70s or late 60s, maybe you do a 9-year note or an 8-year note at a higher rate, like 6%. And then in 9 years or in 8 years or 6 years, you can reset the note based on how the client's doing. While the client's healthy, you can use that excess interest rate to cause part of the note to cancel on the client's death. So in my example there, instead of a $20 million note at 4.6%, depending on age, if she wanted an 8% note, then maybe 60% of that note would self-cancel on her death, because part of that note would be what we call a self-canceling installment note, where you make larger payments, but if the client dies before the note balloons, then the note goes away and is not subject to federal estate tax. Another alternative is to make sure the trustee can make distributions to the children and spray it out, not equally, and give it to the child who's more likely to loan it back to the parent. There's no preconceived plan for that. Another idea that Jerry had was to have the trust invest in tax-sheltered solar energy tax credits, so the client would not have to pay income tax. Have the trust invest in the charitable remainder unit trust, so the client does not have to pay estate tax. And then I want to show you what I came up with. And I'm going to go back to page 97. The first thing I told Jerry, besides that I'm just not as worried about this as he is, because you can toggle off grantor trust status, or you could divide the trust into two and toggle off grantor trust status on one or the other, or you could put the trust in an asset protection jurisdiction and give the trustee the ability to make distributions for the grantor. In fact, Florida has a statute that says that you can have a trust that can reimburse the grantor for the tax paid on the trust assets, even if you do it years after the tax was incurred. I don't like to rely on that statute. I'm not sure what the IRS thinks about that statute, but we do commonly set up asset protection trusts in Nevada or offshore, or in other jurisdictions like South Dakota, Alaska, Delaware, where the trustee may have the discretion to make payments to the grantor. And if you do that, it's not absolutely for sure that it will be out of the grantor's estate, but it's pretty darn sure. If it's highly unlikely that there would ever be a distribution to the grantor, and creditors can't reach into the trust as the result of the power. So if a Florida judge determines that Florida law, not Nevada law, should apply to a Nevada asset protection trust, and a Florida judge therefore determines that the power that the trustee has to make distributions to the grantor allow the grantor's creditors to get into the trust, then the grantor can run up debt and get the debt paid, and therefore he can benefit from the trust, and therefore the trust may be subject to federal estate tax. So what we do on these trusts is we provide the grantor can't benefit from the trust unless trust protectors add him, and they don't have any obligation to do so, and they can only add him if his net worth drops precipitously down well below what is ever expected to drop down to. But even then, there might be a tiny bit of risk. So I said, Jerry, if it's going to be a $10 million gift, and you're concerned that the client may run out of assets, what if we do a $4 million gift to a Nevada Asset Protection Trust and a $6 million gift to a truly unreturnable trust. So now the $6 million is clearly out of his estate. The $4 million is probably out of his estate. And in a few years, we may know whether to say, hey, we're not worried about running out of assets. Everything's fine. We can delete and give up the power to add him as a beneficiary so we don't have an estate tax issue. Or, wow, it's a good thing we did this. He's running out of assets. Let's give him some of the $4 because his net worth has dropped precipitously. I'm going to make a note that I need to fix slide 97 because it says complete gift self dash, which is it's a dashing slide. That slide's handsome and dashing. So that was my technique number 1. My technique number 2 is, as we said, pay a shorter, instead of 1 note at the applicable federal rate, which was 4.8% when we were with Jerry in New York. Now it's dropped to 4% or just about 4%. We could have done a 9-year note at a higher rate, as I said, and then we could have done another note as a self-canceling installment note. So a higher interest rate and the note cancels on death and the client's less likely to run out of assets. But if the client doesn't die on time and lives past the term of the note, then he's taken a lot more assets back into his estate because of the larger note payments. So we ran some numbers on that at slides 99, 100, 101, 102. Who's Jerry, by the way? That's Jerry Hash. He's a professor presently teaching in the LLM program at Boston University, and a wonderful mentor to hundreds and hundreds of tax lawyers. So, page 103, another idea would be, instead of selling for a note, I could sell for a private annuity. And a private annuity is a contract between me and a trust. And under the private annuity contract, in this example, for a 60-year-old, when the applicable federal rate, when the 75/20 rate was 5.4%, I could give a trust $18.29 million in exchange for $1.5 million for life. I wouldn't run out of assets. I'd have $1.5 million for life. Even if I spent $1.5 million a year, I would have another payment coming the next year. And if I die, there's nothing subject to estate tax with a private annuity. But there's an issue with a private annuity, and that is the exhaustion test. If you're not exhausted yet, maybe you'll be exhausted when you hear about the exhaustion test. I go to the IRS tables, and the IRS says if you're going to do this, you need to have enough assets in that trust to make all the payments to you until you reach 110 years old, assuming that the rate of return is the 75/20 rate of 5.4%. So that would require that trust to have $25 million. I'm giving it $18,290,000. I have to put in another $7,932,000 to make that work. Well, how can I reduce the $7,932,000? I could do a private annuity that doesn't start until year 16. And then those first 15 payments that the client wants of $480,000 a year, I could have in the form of a self-canceling installment note. So then my probability of exhaustion test requirement drops down to 6.2 million instead of 7.3 million. It's not a huge amount of savings in gift, but it's worth doing. Certainly worth considering. Another idea is, and Jerry said, okay, that's fine, but he could still run out of assets, and with a private annuity transaction, you cannot toggle off grantor trust status or the annuity payments will become taxable for income tax purposes. So I said, okay, well, I've got a solution for that. I will fund 2 trusts. Grantor trust number 1 will have assets of 110% of 18 million. So I'll give a $2 million gift to Grantor Trust number 1 and then do the private annuity sale for $18,290,000. And then Jerry said, yeah, but now you don't have enough for the guarantee. Where's your $7,300,000? I mean, you don't have enough for the probability of exhaustion test. Where's your other $7,300,000 that needs to go in that trust? I said, well, I'll put that in trust number 2. I'll give trust number 2 the excess of $7,300,000 over $1,800,000 of $5.5 million, and I'll be able to toggle off trust number 2. So then when I ran the numbers, I was able, and I ran the numbers on Estate View and all that stuff, and after all the guarantee fees and all the payments and all that stuff, trust number 1 ran out of assets when the 60-year-old reached age 100. But by that time, Grantor Trust number 2 had $84 million of assets, and the client did not run out of assets because he was getting $1.5 million a year. So if you're trying to zero out the federal estate tax and you have a client who's comfortable living on a certain dollar amount per year, and that gets them below the estate tax exemption level, and by the way, the payments could grow annually, then the SKIN private annuity hybrid with a guarantor trust might be exactly what the doctor of mathematics ordered. Okay. Thanks again for all of you who started and watched me, and we're doing lip sync for the first 22 minutes. All right, the next thing is, a lot of people say, CUPRTs aren't so good, CUPRTs aren't so good, CUPRTs aren't so good. CUPRT stands for Qualified Personal Residence Trust. And they say, why would you use a CUPRT when your home only grows at 3 or 4%, when you could do an installment sale or a sale of growing assets that will grow at a higher rate of return, like the stock market? So I ran the numbers on this, and I'm going to recheck them. That's page 107. I got to take out the words check these numbers. I did check these numbers. So I put a $7.4 million home in a CUPRT for a 65-year-old client, 10-year possessory term, won't have to pay any rent for the first 10 years, has to live 10 years to have this out of her estate, and she'll pay rent based upon approximately 7% of the value per home per year for another 10 years. She'll die in year 20. That's only a $3.5 million gift. So I only used $3.5 million of her exemption. And after 20 years, the growth in the home plus the 7% rent removes $28.5 million from her estate. So not even counting the burn that happens on the growth of the assets that derive from the rent, she's going to have estate tax savings of $11 million. That's not bad. Now, there's a little bit of capital gains tax that the family's going to have to pay when they sell the home that I'm going to have to put into this the next time you see this slide. The other alternative, though, is she puts $5 million into an LLC with a 30% discount. 99% of the LLC non-voting is worth $3.5 million. She's used the same $3.5 million of her exemption. Over 20 years, the LLC grows to $18 million. She saved that, plus the burn has taken $7 million out of her estate because of paying the income tax on the income of the LLC. So the estate tax savings, $10 million. So the CUPRT did better, except when you enter into the consideration of the loss of the capital gains tax exclusion. If there is a capital gains tax exclusion loss, that's not for sure in my mind, but I think most advisors think that you would have capital gains on the sale of the home. But if gifting stocks and growth assets is not enough and the only thing the client has left is the QPERT, then I would certainly consider the qualified personal residence trust. The other innovative thing that I never saw anywhere until I thought of it, that doesn't mean nobody else thought of it first, but it's kind of neat to have those aha moments. You have a client with a $20 million stock and bond portfolio, and she wants to use her $14 million exemption before the end of 2025 because the exemption is scheduled to go to half in 2026. And you say, well, we're going to be able to take a 30% discount on this LLC. You won't have to pay any gift tax. And she says, are you absolutely 1,000% sure that I'm not going to pay gift tax? Because if there's any chance I'm not going to pay gift tax, then I'm just going to make a $14 million gift. I'm not going to use that LLC. Well, that extra $6 million out of her estate over 30 years, $6 million goes to $12 million, goes to $24 million times 40%. That's a huge estate tax savings. I really want her to do that, but she doesn't want to take the risk. So what I'm going to do is I'm going to put the $20 million of assets into that LLC, and I'm going to have her transfer 64% of the LLC to the irrevocable trust. And we're going to call that 64% of 20 million is 12 million 8. Take a discount, that's a $9 million gift. Now I'm going to have her take the other 35% and put that into what we call a lifetime Q-tip trust, which is gift tax immune. So with a lifetime Q-tip trust, you put it in there, it pays income to your spouse, and you can decide by the next year, in September of the next year, whether that's considered to be a gift or whether it's considered to qualify for the marital deduction. And you can use a formula for that. So I've probably lost half of you, including all the CPAs. But what you do is, in the tax return that you file in 2026, you make a formula election. The formula election says, I think that this Q-tip is a $7 million to gift, or I'm sorry, a smaller gift. I elect marital deduction treatment to the extent necessary so I have zero gift tax. So if the 30% discount holds up, there's no marital deduction election under that formula, and you've used up the whole exemption using all 20 million of the assets, or 99% of 20 million of the assets. On the other hand, if the discount is less than 30%, then part of the lifetime Q-tip trust is a credit shelter trust out of the estate, and part of it qualifies for the marital deduction. There's no gift tax risk. When an auditor looks at this and says, oh, I can't get any gift tax out of it, how hard are they going to try to deny a 30% discount? Now, the cost of doing this is a second trust, and the fact that the 35% of the LLC income is going to go to the spouse and eventually be subject to estate and gift tax. But it's still something that I would certainly consider doing. And I'm absolutely sure that I did not invent it. Okay, I'm going to go look at questions, and then we're going to play with estate view if anyone wants to. I don't see any new questions. That's kind of peculiar. But Brian said, I'm a CPA and I'm still here. Thank you, Brian. It's good to know. All right, so now if I can move my slide deck over, I am on estate view. And first, for those, I know there's a lot of people on here who are not tax professionals, so I'll just show you a little bit about how the estate and gift tax works. Oh, I want to mention the news. So if you're on estate view, you can click on news, and then I get my Google News, my Google Business News. I can just get regular Google News. So I can, in one place, I can see my Google News, my Google Business News, my New York Times estate planning, my Yahoo Finance, or I could change this if I want to see my Thomson Reuters news. And you can make this a separate icon on your computer. So instead of having to see Google News, which I was normally doing, now I see my tax news and my Google News all at once. And I can also get summaries. So the AI in each of these news feeds, not in Estate View, actually summarizes it for you. If you're in Estate View and you have any questions or issues, click on chat and go ahead and put down your question, like, what am I? Question mark. Click send, and that actually generates an email to me and 5 other people, and whoever answers it first answers it for you. So we're answering things usually within 15 to 30 minutes. Okay, so now I go back to my calculators, and I go to a married couple, and they have a $3 million house, $19 million of investments, and I have the first spouse dying in 17 years with a rate of return of about 6.4%, and the second spouse dying in year 20. I can change that around, have the first spouse die sooner, for example. That changes all the numbers. And if I do no planning, there's going to be a big estate tax, $20 million. If I fund a credit shelter trust on the first death, the estate tax goes down a little bit. I could do a qualified personal residence trust. I can go to qualified personal residence trust. I can, let me see here, click on the qualified personal residence trust up here, use Cupert. And now if I click on Cupert, it shows me that if you do a long Cupert, it could fail, but I could do a 9-year Cupert. So if the home goes into the Cupert, if the $3 million home goes into the qualified personal residence trust, after 20 years, the trust is worth $6 million. The rent that was paid is worth $679. So the savings, the estate tax went from $17.6 million to $16.2 million because of the Cupert. So the Cupert did save some assets. In fact, it should have been more. So then I can do annual gifting if I want to do annual gifting, but I'll go down to an installment sale. So these people have $49 million on the second death. They're starting off with $19 million, and even after these planning techniques, they still have $49 million. So we'll just show you the power of the installment sale. So I've clicked on installment sale, and we'll put $9 million of assets into an LLC. We'll take we'll take a 28% discount. 99% of that LLC is worth $6.6 million. We'll make a $666,000 gift to the irrevocable trust, so we have some ballast there. And right now, the interest rate on the note would need to be 4.06%, which is the October applicable federal rate. We'll do a 20-year note. I see the note payments back are going to be $270,000 a year. If he dies during the note term, we're going to discount the value of the note by 10%, because who would want a note? And now, when I click on installment sale, the estate tax, that was one of my law students groaning. When I click on installment sale, the estate tax goes from $14 million to $7 million. That's a lot of savings for a $600,000 gift, isn't it? And now I see that after the installment sale, there was $9 million in the installment sale trust minus the note, and by the second death, there was $19 million in the installment sale trust. So is that enough? They could do a larger installment sale, or they could consider a charitable lead annuity trust. So with a charitable lead annuity trust, I'll go down to charitable lead annuity trust. I'll choose that. And I'm going to say that our charitable lead annuity trust will end up with 60% going to charity and 40% going to the family over a 20-year period. And I'll click on charitable testamentary charity. And now my, what did I do wrong there? Oh, got a check there. So now my estate tax just went to zero. The beneficiaries are going to get $58 million initially, $7 million after 20 years, and they've lost $3.5 million to charity. They've also have to wait 20 years to get $7 million. So it is a sacrifice. In fact, I can show it to you on the timeline. So to give you a little orientation, here's a timeline, and I can even make the first dying spouse die sooner or later. I really like that. Like if he doesn't pay the bill, he dies sooner. If he pays the bill, he dies later. But what you see here is in blue is an annual gifting trust. They give $18,000 a year per child. And then you've got the credit shelter trust that opens on the first death. And then you've got the bypass trust. You got the personal residence there. And then you've got the assets here in green and red. But on death, that's what red takes away from you. If you'll do the installment sale, then the estate tax goes way down. And the installment sale trust is becomes a very prominent player in, and that's what that is all across the bottom there, is the installment sale trust. Now, if I switch to testamentary charity, then now you see a lot more comes off the table, but it ends up in a clat that mostly goes to charity, but in large part does go to the descendants. Now, I can go back to installment sale. I can go back to trust logistics, and I can say, well, how much of an installment sale do I have to do to completely avoid the estate tax? Well, all I have to do is click up here, and as I click up here, the installment sale gets larger, the investments get smaller, and the estate tax gets smaller. So I can click up here to the installment sale, and hopefully the investments won't run out. Yep. So if I put everything but $1.5 million in the house into the installment sale, I get $12 million back. Now I click on installment sale, there's no estate tax. The estate tax goes from $14 million to zero. And let's see, on a timeline, there would still be estate tax if the client dies during this period of time. Now, what I might want to do for these clients is just buy a little bit of life insurance. It looks like I need life insurance for about 15 years. So I can go to the life insurance estimator, and if I buy life insurance on the younger female, 20-year term policy, if she's preferred, then it's $2,500 a year. So maybe they buy a life insurance policy. By the way, we don't sell life insurance, and the software doesn't sell life insurance. We just like to know how much it costs. So that's a typical cost. So then, for those of you who are users of the software, not users of drugs and alcohol, I can go to Generate Client Letter. I can select the scenarios that I want to see: no planning, bypass, QPERT, annual gifting, discounted gifting, not going to show life insurance, not going to show a large gift, installment sale, testamentary charity, show introduction, show timelines, click client letter. Now at this point, the letter is being written, and you see across the bottom, all the squirrels are writing the letter, and they're proofreading the letter, and they're reformatting the letter, and all that stuff. So now I open the letter for you. I can also do a PowerPoint, as you know. And then I can go ahead and I think if I'm smart enough, I can make this one of the handouts. And this is an editable Word letter. So now I'll send this to everybody, and you've got my inputs here, and you have an explanation, and you have the outputs for each of these scenarios. So if you're a layman and you want to understand how the estate tax system works, maybe watching this again, especially the last part where you can actually hear me, will be good. And maybe I can find a way to go ahead and forward this into the box there, into the handouts. I have to open the handouts. Okay, and then I take that, move it, drag and drop it, and it's downloading. So while it's downloading, I will go back to, well, maybe it's not downloading. All right, anyway, I tried. Sorry, I'll email it to everybody. So now I'm going to go back to the software. Are there any questions? When will this guy be done? Oh, not soon. I'm just going to show you one more thing. Oh, by the way, don't forget that you can share this module with the client. So I'll go ahead and make this easy for everybody. I'm going to make the code 0, 1, 2, 3, 4, 5. Now, if you will take the URL PDF I'm about to send to everybody that'll come with this video, you'll be able to load this HTTP address into your computer, and then that'll open up this calculator, and you'll be able to use it for free for 12 days. Don't tell my subscribers that I gave you this calculator free for 12 days, and it'll open with these settings. So Brittany will make sure to remember that that happens. So now I just want to go to the CRAT calculator, and I'll go to Pro Plus, and here's what I did. I'll click to see results. So this is showing you a 20-year charitable remainder annuity trust. The client is 70 years old, which is really not pertinent. The $20 million IRA goes into it, and I'm going to set a payment rate of 5%. The growth rate is not relevant initially. In fact, let me go to File New here. Okay, so yep, all right, 20-year CRAT, grantor's age 70. Let's put the $20 million in there. I'll just click up to 20 million. I'm too lazy to type in T20M. Okay. The payment rate's going to be based on 5%, 75/20 rate, 5.2%. Assets growing at 7.5%. 5% of 20 million is $1 million. Aren't you glad I had a computer to tell me that? Now, the value of the charitable interest here is $7,746,000. It would, if you needed an $8 million charitable deduction, you would not get it here. The total annuity payments, $20,800,000. The illustrated end value for charity, $41 million. And the real present value of that, the real present value of giving me $1 million a year for 20 years is at a 6.2% discount rate is $10,000,008. and the real value to charity is 11 million. And I call that the truth in giving disclosure. We're the only calculator that has that. We're also the only calculator that shows you that you need a part year payment. In the charitable annuity trust world, you have to prorate. You have a calendar year payment. So the first payment and the last payment is prorated unless you started on January 1st. So I wanted to show an 80% deduction. So what I had to do was to reduce the number of years. So if you look here, and in fact, I'm on 20 years, and the deduction is 7,000,007. So I'm going to duplicate that now. I click duplicate there, and now you have the same thing again. You got 20, 20, 7,000,007. Everything's the same. But what if I make it a 19-year? If I make it a 19-year CRAT, now the gift is 8,109,000. So if I wanted an 80% deduction, I would have made it a 19-year CRAT. But the other thing I did was, just for the purposes of illustration, just because the rate right now is 5.2%, that doesn't mean that it can't go up and down, and we know it does go up and down. So the other thing I could do here, and here's CRAT number three, is I could just go back up to 20 years, and then I could take the 75/20 rate and go to 5.4%. And when I got the 5.4% 75/20 rate, it went to 7,000,009, and I said, close enough. And I ran the numbers on that, and then you see that based upon a 7.5% rate of return, this person is never going to run out of assets, and a lot is going to end up going to charity. 41 million ends up going to charity. That's a lot going to charity. But what happens if the investments aren't good? This is 7.5%. So I can go back to here, and I said, what if the rate of return is 0? So I click on duplicate again, and then here I click on rate of return. Let me find where rate of return is. Where are you, silly rate of return? It said 7.5. There it is. I'm going to move this down to 0. Move it down to 0. And now I see that there's nothing left for charity. There's 0 left for charity, but the client got their payments. So the spreadsheet looks like that. And it's just a coincidence that it ran out right at the end. I didn't mean for it to do that, but it makes sense, $1 million a year on 0 rate of return. So that would be why you would choose the CRAT. So now you say, those of you who are remaining, and about 75% of you are remaining, probably because half of those have this being recorded and they're out playing golf or doing something a lot better than this, and maybe some of you are still actually watching it. But now I'll go to the CRUT. I'll show you what I did on the charitable remainder unitrust. By the way, I find this stuff to be interesting. I'll admit it. So here's a charitable remainder unitrust, and I ran 4 of them. I found that at a 5.2% 75/20 rate, I had to I could use a 5.2% payout rate, a 5.2% 75/20 rate, and an 18-year CRUT, and that got me my $8 million charitable deduction. How did I get to that number? I played. I just cranked up and down a little bit. One of the things that I really like about how Kevin designed Estate View with me was that we can click up and down instead of having to type back in the same number over and over again. So then the first CRUT I ran, 5.2%, 75/20 rate. It's a as I said, an 18-year charitable remainder unit trust, assets growing at 6%, starting with 20 million, and it's a NIMCRUT with no payments until year 11. So the spreadsheet for that shows you that there's no payments, there's no actual payments made in the first 10 years. But son of a gun, in year 11, you get a $14 million payment. You haven't paid any income tax on the IRA income. You get this $14 million payment, and then the payments continue at about $1.15 million. And at the end of the day, Charity gets $23 million. But the present value of Charity was about $8 million, and that was the $8 million deduction. It's fair. And the present value of the annuity is $12 million. So that was the CRUT. I mean, that was the first one. Now, the second one, I'll pull this back down. See what I did different on the second one. I think I changed the rate of return here to 7.5%. So what happens at 7.5%? This is where it's so much better than the CRAT, because at 7.5%, these payments become somewhat immense. They become nice and large. So the actual, this one was not, let me see, this was let me go to CRUT number 2. CRUT number 2, this was not, this is a 7.5% rate of return, not a flip NIMCRUT. This was just a CRUT. And you see the payments go up nicely, not just $1 million a year, but they go up. At year 10, they're at $1.3 million. At year 18, they're $1.5 million. The last payment is $1.2 million. Charity gets $12 million. Or the present value of the payments, $13 million. Charity gets $10 million. That's good. You get the deferral. And then I did CRUT number 3 right here. And this was the same thing, but I clicked NIMCRUT. Trying to remember. CRUT number 3. Let's go over here. CRUT number 3 was a 0% rate of return. So 0% rate of return, not such a good thing. I mean, compared to, remember with the CRAT, with a 0% rate of return, you get everything back. But with the CRUT, your payments go down. You're at $670 in year 10, $331 in year 19. The Charity gets a lot more. The Charity gets what, $2 million. Let's see what's left for the Charity. Charity gets $7.6 million. That's not a good day for the beneficiaries. Present value of the beneficiaries payment, $7.7 million. Present value for the Charity, $2.6 million. Not as bad as you would have thought, because the future value of $7.6 million is only $2.6 million. But for those of you who are math geeks like me, I hope you enjoyed this, because I sure did. Now I can share this calculator also, and we'll go with code 566270. Generate URL, click to copyboard. Brittany will help me transmit that. And then finally, what I can do before I forget is I will generate PowerPoints for you for each of the 4 CRUTs. Click Generate PowerPoint, submit. Now it's generating the 4 PowerPoints. So the PowerPoints open up immediately. I got all 4 of them. So to refresh your memory, I'm doing a flip. This is a flip NIMCRUT. First, you've got the assets going to the CRUT, then you defer payments, then you release the deferred payments in a particular year, then the rest over a number of years. There's a disclaimer, don't listen to this, nothing's right. Then there's a summary of what we've done, a little summary of characteristics of these things, all my assumptions, maybe more for the planner than the client. That's what I'm being told, that it's a little bit too complicated for clients. But, at least this proves up what's going on. I guess we do need to do a simplified version, but it does show the NIMCRUT gets 20 million, tax deduction 8 million, saves 2.9 million in income taxes, annual payments to the grantor 5.2% for a term of 18 years. In year 18, distributes the remainder. So, and then you give the client the the spreadsheet also. So the spreadsheet needs to be bigger, I think. There's always room for improvement. That's what my wife tells me. All right, and then finally, just to go back here before I forget, we'll go ahead and make PowerPoints for the CRAT illustrations. So I'll click General Illustrations, click the CRAT, click the CRAT. How many times can you say that fast? Click Submit. So those are all up. Let me see if there were any other questions. How do you buy Estate View? That's a great question, and I hope you answer it. You go to, let me see here, I'll show you. You go to estateview.link. Oh, that doesn't work for me because I already own it. Let me find my PowerPoint here. I'll open my PowerPoint. Open PowerPoint, please. Open. I've got so many PowerPoints here, I can't find it. Well, how do you find Estate View? You go to estateview.info. When you're at this library, at estateview.info, you can go to the library, click library. And the library, then if you click on any of these buttons, it gives you a video showing you how to use the particular calculator. So that's one thing I wanted to show you. And then to purchase Estate View, you go to click here to purchase, and then there's it's basically $4.99 a year for everything it does that you just saw. If you're interested only in doing calculations in the way that traditional calculators work, it's $1.99 a year, and if you want almost everything, it's $3.99 a year. And if you buy it today and you want a big discount, send me an email and I'll make you an offer that you could refuse if you wanted to. All right, so that is today's webinar. I would like to thank Jonathan Blottmacher, Jerry Hesch, and Bob Keebler for everything they've done to help me develop Estate View and therefore develop these programs. If you've enjoyed what you've seen today, then you're weird. But I still hope you had a great time. We're sorry about the sound issues. They were Gassman's fault. He shouldn't have tried to use a Jabra speakerphone. All right. So sorry again. Have a fantastic day, and may all of your numbers come out rounded to the nearest decimal. Thank you.